The top three things in my notebook this morning are indeed the Japanese yen, Russia, and the 10-year bond yield here in the USA. So first on the Japanese yen, don't forget that most of what bailed people out in U.S. stocks from the fetal position that was October the 13th, don't forget that, again, 150 points, 160 points lower in the S&P 500, was indeed two central planners coming out with emotional reactions to it all. One was Bullard and one was the Japanese. Now, the Japanese experiment is fantastic to watch. So again, they've had 3 up days in the last 4, but where do we go from here? More importantly, look at the risk range in both the Japanese yen, which is wacky wide. And a wacky wide risk range is a leading indicator for what? Volatility. So there's a wacky wide risk range in the Japanese yen of 111 to 117, risk range being the immediate term. And then in the Nikkei, get this, the risk range is now 14,602 to 17,378. Now you can drive a wacky tobacco Mack truck through that risk range. And that means that you could go down, literally, you could go down 15% in a day in Japan if people decide to not suspend disbelief. So again, this experiment in central planning is going the wrong way. And if you can't see that, look at point number 2 this morning, which is indeed Russia. Now Russia, just newsflash, is crashing. It's the top 6 economy in the world, notwithstanding that other places are also crashing, like Brazil, which is number 7 in the world, and Japan, by the way, is in the top 7 too. So with all these things crashing, of course, nothing could possibly go wrong from the all-time highs in the S&P 500. But indeed, Russia is linked to the deflation in oil. So again, follow the bouncing ball. The Japanese and the Europeans burn their currency. The US dollar goes up. Everyone and their brother says that's good for the U.S. economy, when in reality, it's deflation. Stupid. Again, deflation. The Russian deflation. Not good. We reiterate the short call on Russia. And then finally, the 10-year bond yield. How many times this year, I guess we're going into the 10th month this year, that you could buy bonds, the long bond being on a pullback? Now, a friendly reminder that the return, the rate of return on the long bond, which is TLT, if you want to look at the 20-year version of that, is much greater than the Russell 2000. In fact, it's like 1,900 basis points better than the Russell 2000. It's even better than the almighty S&P 500. So again, on bad jobs data, on global growth slowing data, what do? You buy the long bond. Okay? That's it. Simple, simple. Even a mucker with an M can do it. Those are your top 3 things.